Today we'll be talking about the crypto crash. More crashing. Kind of happened a bunch before from like 60K downwards, and it just keeps going. Kind of stabilized at 20K for Bitcoin and for some time, and now it's finally cracked below. So I'm really excited for that. U.S. midterm election and also the CPI report for October. For today's topic, we'll again talk about the crypto crash first, then U.S. midterm election, cover up with October CPI. Then we'll dive into the U.S. labor market a little bit before going into forecasting Fed's point of view and what kind of, what's their kind of policy and actions going forward, and finally covering off with U.S. dollar and commodities. So first up, talking about crypto crash. So like I mentioned before, they're all just Ponzi schemes, and the biggest one yet. And what we're seeing is the global cryptocurrency market values finally fell a bit below $1 trillion. So the most recent one started with FTX having news of being bought by Binance due to their liquidity issues, but now today they finally filed officially for bankruptcy. And the CEO, who was kind of known to be, the next biggest, billionaire, has, stepped down from being CEO, and all the fat is all gone, all the air is coming out. Another exchange, BlockFi, is pausing withdrawal due to their liquidity issue. So all these exchanges, like why is this happening? So they spent a lot of money in marketing. Like for example, Crypto.com buying, a naming rights of the Lakers arena and spending so much money in marketing. But where's all this money coming from, right? And on top of that, they leveraged up, meaning, they borrow money, and we don't see that. No one, like, that's the thing, like, people always misunderstand, they mistook, genius for leverage, or leverage for genius. And that's an issue, because what happens is, you just levered up and you increase the risk so much. You didn't really improve the underlying item, but what you did was, you just borrowed money. And they're all now blowing up with, rapid increase in higher rates. And so what happens is the downward spiral continues, where, they need funds to be able to pay all these, higher rates, so they have to sell some of their, crypto. And when they sell, then the price falls. And when the price falls, their clients, some of them want to get out as well. And so everyone is fighting for the exit. That's why we're seeing big volatility to the downside. Interestingly, this time it hasn't really impacted investor risk appetite before, because what we saw before is when crypto falls, that's when you see a lot of people exit tech stocks, and we haven't seen that happening just yet. And the question is, how many of these, crypto investors blowing up, how many would it take until, maybe some of them have more risk stock portfolios as well. So we'll see about that. But in my mind, it has a long way down to go. Next target will be like 15,000 for Bitcoin, and then maybe 12,500, and we'll see if it gets to, I think my ending target is about 5,000. So let's see if it gets there. U.S. midterm election. So the polls leading up to the voting showed that to GOP taking over, a big red wave. They Republicans led on issues like economy, inflation, and crime. Democrats had a slight lead on issues like women's rights, climate change. But the red wave didn't occur. And honestly, in my opinion, the Republicans lucked out, because as we enter, worse economic situations, they can continue to blame the Democrat Party. And we'll see what happens because the polls are they're still counting, which is kind of ridiculous. Like, why does it take so many days? We'll kind of see how it goes. But what would that mean when it comes to, the remaining 2 years of President Biden's term in terms of policy making, and how the market will continue to absorb this news. So October CPI, the headline came in less than expected at 7.7, which was less than last month's at 8.2, and the big reason for that was a big drop in second-hand cars, and I do expect to continue in terms of prices falling, and it was like the price initially rose part of the chip shortage in 2021, both because of shipping, and also crypto was hot back then, so it took up a lot of chips, computer chips, and that was the main part that they were waiting for. And now that crypto is falling, well, it's fell sometime, and I think now it's reflecting in the supply chain all the way through in terms of new cars coming out. So we see new car prices also falling. That there will be continued drop in terms of second-hand car price. We also saw a drop in medical expenses, and this is most likely due to how they calculate it. They use medical insurance, less medical spending, and since a lot of people couldn't go to see doctors during COVID time, like a lot of people were just staying home, not seeing their doctors as much, while they still pay their medical insurance, like they didn't stop paying them. And so we saw, medical spending decreasing because, people aren't going to see their doctors as much, while medical insurance remains the same. So if you have the same input, but the output is, so you have the same revenue, but the expense is less, that's when you see, a drop in medical. And finally, there's the base year effect. When comparing to like a higher October 2021, because that's really when inflation really picked up in 2021, you require a much bigger increase, which is like, if calculus, it's the rate of change, right? And when it comes to velocity and acceleration, so our velocity prices can still be going up. They're just going up at a slower or lesser rate, meaning acceleration is coming down. But we won't see prices fall until we have a negative CPI. So CPI can still, like, it doesn't have to be elevated or much higher at like 8%. I think maybe it will come below 7, possibly, like it'll be below 8, even possibly below 7 for the next one. And then next year we might see 5, all the way down to like 2.5. But as long as CPI is positive, and until it turns negative, we won't see prices come down. And the key point will be looking at month over month. I've talked about this before instead of year over year to kind of give you a picture of where we're going when it comes to prices. Now let's talk about U.S. labor market. So the U.S. Tech companies have been laying off employees. So as mentioned before, they overestimated the demand surge in 2021 due to the reopening and also massive money spending, and mistook that annual increase like being continuous rather than a one-time impulse. For example, like everyone bought so much stuff that they wouldn't have otherwise, and they front-loaded all their spending. Like a lot of people bought home exercise machines. You're not going to buy one for like 10-20 years, maybe 10-15. But the point is, like, a lot of people front-loaded the spending they otherwise wouldn't have done, and now they don't have, now that's not happening anymore. But these companies took that as an annual increase thing. Now, why is the labor market still tight though? And the reason for that is the low-skilled labor sector is still lacking. There's not enough people to fill those positions yet, and that's partly due to the population growth. If you think about it, you gotta backtrack like 20 years, right? So 20 years ago, the what we have in terms of population growth is not high enough to meet the kind of labor demand today, right? In terms of the lower skill branch, and what we'll see is that as more and more people are getting laid off, maybe they'll shift to a more lower skill, like they shift down to lower skilled labor, and that's how the labor market will be filled. And the Fed talked about this, where their natural rate of unemployment, because that's their two mandates, right? Price control, price stability, and also stable employment. And they mentioned they expect the natural rate of unemployment to be like 5%, and meaning they're willing to accept higher unemployment until they're willing to change their policy due to unemployment. And another thing that this impacts is the high-end spending is shrinking because the high-tech earning employees are losing their jobs and potentially moving to lower-paying jobs. And what that means is, again, that becomes a spiral because there's less high-end spending available, and so the high-end spending companies, like where they would spend their money, also loses the revenue, and then potentially they have to fire staff, and this spiral will continue until the Fed thinks that it's enough. Now let's talk about forecasting what the Fed's point of view is and what they will be doing. So the market is forecasting one more 50 basis point hike in December, and maybe one more 25 basis point rate hike in 2023, and then possibly rate cuts in 2023, maybe end of the year. And the risk of that idea is that what if the Fed tightening cycle doesn't end with rate hike cycle? Meaning, yes, rate hikes are done with 75 basis point within 2 meetings, but what if QT continues? What if they're not done tightening, like they think rates are fine, but then they keep shrinking liquidity? And what if Fed use higher prices, meaning, yes, again, so CPI year over year we're seeing a downturn, but then because it hasn't turned negative, prices continues to increase. And what if the Fed use that to continue their tightening cycle? So these are risks that the market is not seeing. The market was looking for anything to rally on, and the second the October CPI came out lower than expected, they thought, the Fed's ready, they're coming in, they will now, stop tightening and potentially easing, in 2023. I don't think the tightening cycle has ended just yet. We'll have to see what happens, with this, the Treasury and Treasury market, and also the Fed's balance sheet. Finally, we'll wrap up with U.S. dollar and commodities. So U.S. dollar falling sharply as rate hike pausing anticipation, and it's also due to the rebound in other currencies like the yen. And the key part to see right now looks like there's a short-term reverse head, there's a short-term head and shoulders formation. So we kind of have to see if it can get back up to 110 for the DXY. And commodities, they reacted as expected with the fall in dollar. Precious metals shot sharply up, and these are big moves that you don't normally see in that sector. And I would caution anyone chasing the big moves. It would be more favorable you just kind of wait for everyone to dive in, and then it kind of takes a breather. It would be more favorable for a back test of support before anyone try to load up more. I actually sold some of my position because of the big run up, and just waiting to get back in. With oil, $90 remain an important kind of support. We'll see as winter continues to approach. I think, or continuing, I think oil has great opportunity, and if you are like the downside risk, should be protected from OPEC Plus with their continued cutting of production. The only kind of headwind is again the dollar and fall in demand due to recession. Now, but the problem is another kind of thinking caveat. If oil continues to move up with winter and with low supply, and also the strategic reserve, gone, essentially, Biden pushed all of it out, and they have to buy back, and oil prices go way back up. What will this do in terms of contributing to the CPI? And what will and if the increase of energy remains high, and that puts more pressure on a higher CPI, or at least it doesn't fall as much as it otherwise would have, what will that mean when it comes to the Fed pivot anticipation by the market? So these are things that the market is not taking account